Well, good morning, everyone. It's Thomas Montgomery. It's a beautiful Thursday morning, August 14th, 2025. We get together most weekday mornings at this time to talk about strategies, tips, techniques, share success stories, and support each of you. My screen is shared, and you should see not our website, but Bank of America. And I'll explain why in just a moment. And then our notes screen, which is kind of where we're going to navigate through. So our website is, of course, not Bank of America, but our website is 509pacific.org. Best way to reach us is the text support line. Continue to have people call it, but it's not answered live, at least not normally. 903-347-8042. So have to start with the basics because part of this is meeting the grant requirements. We are a 501c3 nonprofit. We've applied for and received a grant. The grant has three mandates, just very briefly. We're supposed to help improve financial literacy. This Zoom is part of that. Secondly, we give away free shelf corps. If that doesn't make sense, you can go to 509 Pacific and see trainings of why that's relevant. But the bottom line is if people want business funding, they need to have a fundable business. Most people don't. So to help facilitate that, we give away shelf corps. You'll see more of that on 509 Pacific. And then the goal is to take that knowledge and take those shelf corps and then leverage that to get money into clients' pockets, into their bank accounts, if you will, so they can start, grow a business, so they can hire employees, contribute to the tax base, and so forth. So that's the big picture, the macro picture. As far as our agenda today, we just covered number one in brief. We didn't go too deep into it, but it'll be good enough for now. I want to spend most of our time on number two, talking about asset-based lending. Now, we've been visiting about asset-based lending for a couple of weeks. In my opinion, it's a better funding vehicle for most, not all, but most small businesses, better than an SBA loan. And, you know, that's how we got started. All of us used to work at the SBA. Not that there's anything wrong with SBA or traditional loans, but the ABL model has some significant advantages. Today, we're going to go through a step-by-step guide. So if you feel like you need a little better grounding on what this whole ABL thing is, you can go to our website and there's some on-demand. There is an on-demand training there. Then we'll go through Q&A. So why do we have the Bank of America website posted in the background? Because it's not us. I'm not trying to represent that we're Bank of America or Bank of America is us. That's not true. But we have access to lots, many of different lenders that offer ABL. Some people, they're not as sophisticated as you and I, and so they can be pessimists. Oh, ABL is not real. Well, it is very much real. Not only is it real, most of the major banks have divisions or departments that are focused specifically on this. So Bank of America is just simply one of the lenders we have access to, certainly not the only one. And in fact, they don't like the smaller deals. But let's just briefly look at how Bank of America addresses asset-based lending, and then we'll get over to our step-by-step guide that if you knew of a client that was looking for funding, how we could take them through the process very quickly, very painlessly, with less than $500 total out of pocket to get them $1 million ABL loan. But we'll get to the guide in a moment. So let's get over here to the Bank of America website. So this is a live site. I didn't cut and paste. I didn't redact. I didn't change anything. So what does Bank of America say about asset-based lending? They say, not me, this is what they say. If your company is seeking financing solutions of, 5 million or more. Some of you have come back because our floor for ABL is 1 million because we do have some lenders that go down to 1 million. Bank of America doesn't want to dick around with the small stuff. So if it's not at least 5 million, they won't even consider it. But we do have other lenders that go down to 1 million because I know some of you say, well, I've got a client that just needs 100,000. Why can't we just get them ABL for 100,000? That's not the right size for that type of instrument. So Bank of America starts at 5 million, but we have others that'll go down as low as 1 million. But let's continue on. Bank of America says you can benefit from the flexibility and versatility of an asset-based structure. Whether you're planning on an acquisition, a turnaround, need more flexible financing solutions, the ABL can help businesses throughout the US, Canada, and Europe. Now, again, we're still on Bank of America. We are not Bank of America. Bank of America is not us, but I'm just trying to connect the dots so we all see this is the real deal. How do they say that it works? I'm going to give you how it works for our prep process step by step. But they describe that ABLs can either be a line of credit or a term loan. Now, you all are pretty sophisticated, so I think you know the difference between a line of credit and a term loan, but in case it's not clear, let's just clarify it. So if we went and got a $5 million ABL loan from Bank of America, which they're looking at loaning, right? They wouldn't have it featured on their website if it wasn't something they wanted to do. A term loan means that entire $5 million hits your client's account at once, whereby alternatively, a line of credit is an approval amount of $5 million and they can pull from it as they need. They wouldn't incur interest on anything they've not accessed. So it could be positioned either way. So whatever the client wants. So with that being said, they clarify, oh, it can be used for all kinds of different things. And the truth is normally it's unrestricted funds, which means it can be used for anything. But it's not about what I'm saying. This is about what Bank of America, one of the largest banks in the United States, in the world, says. They say it can be used for working capital, acquisitions, turnaround financing, capital expenditures, debt financing, growth recapitalization, refinancing, restructuring, buyout, whole bunch. So, and you can even contact, here's Seth. You know, if you want to contact Seth, I'm literally giving you Seth's email, his direct personal email. Email Seth if you want and talk to them about Bank of America. But our model is to take care of everything for you, so you don't have to call Seth if you want us to take care of it. So let's go over to the step-by-step process. But before I do that, anyone have any comments or feedback on Bank of America's approach? So this is just one lender in the marketplace where there's many that is looking to do asset-based loans. Where you and I come in, and when I show this to you, you might say, well, that's crazy, Tom. Why are you doing that? Everyone's just going to go right to Bank of America. They're going to go apply with Seth and cut us out. Well, if they qualify, they really don't need us. But most businesses don't qualify, and that's where you and I come in. We're what's considered technical advisors. So I don't really need, you and I don't need to spend our time with people that are already qualified for this. They just need to go ahead and contact Seth. That's great. But 99 out of 100 businesses are not ready to contact Seth, and that's where you and I come in. And that's where the step-by-step. But anyone have comments or feedback on how Bank of America is approaching this? And Brian's bringing the point. That's right. So each lender has their own floor. Not all of them have a floor of 5 million. Our floor, where many of the lenders are at, it's 1 million. So we can go as low as 1 million. And then Doug, we got several Dougs on here, 3 Dougs, but Doug's bringing up a point which shows it's my fault, not his. He's saying, well, what if the client doesn't have the collateral, doesn't have the assets? Well, we provide that. That's what we do, Doug. So let me describe that rather than belabor it anymore. All right, so let's go through the step-by-step guide. So we've already clarified what ABLs are. It's a type of funding that businesses can qualify for. It can be in the form of a line of credit or a term loan. What makes it different, and what I would argue makes it better, is instead of generalized underwriting over all these different variables like an SBA loan, in this case, it's focused on one specific variable, which of course we can provide. So what I want to do is look at a timeline and a process. Now, our attorneys want me to say, you know, this is just an example. It's not an offer. It's not a guarantee. But let's just go through what it would normally look like if you were to want to understand a step-by-step guide of how to help a client access ABL. Fair enough? Let's go through it. Well, we need to start with having the foundation of a fundable business. As we said early on, and we say pretty much daily, if you want business funding, you need to have a fundable business. Most people don't have that. So where you and I start is number 2, is providing them a free shelf corp. Yes, there's a processing fee. The amount of the processing fee you determine. If they come directly through us, or for those of you that don't mark it up, they're getting a shelf corp for under $500. And if we follow the plan the way it should work, that should be their entire out-of-pocket cost. We should be able to deliver all of these steps, which we're going to go through, and the entire cost out of pocket to the client would be $500. Everything else will be funded by the capital raise. That's the concept. Okay, so we start here. They can either get a shelf corp from those of you that are running branch offices or resellers. They can come to our website, 509 Pacific, and get one. But regardless, we're going to start with the shelf corp. So we have that foundation to build off of. If you have any questions, comments, concerns, just type them in. So what happens then? What happens after I spend my $500 and sign up for the shelf corp? Well, we need about 7 days. And I know the world is, add water and microwave it or instant results, but we need about 7 days to get the shelf corp documents over into the client's hands. And then in about 7 days, and I see Anthony's asking, that's calendar days, not business days, because if it were business days, you don't count weekends, it'd be like a week and a half. But normally within 1 week, we can get the shelf corp documents into the client's hands, and we go ahead and apply for first tranche funding. FTF, we call it. Let me go ahead and add that acronym. Because what we want to do with first tranche funding is get an injection of capital into the client's hands right away. So don't misconstrue. I'm not saying, oh, we're going to go get that 1 million or 5 million in 7 days. No. First tranche, initial tranche. So in about 7 days, we'll get the shelf corp deliverables to the client, and we're going to automatically go for the first round, FTF, first tranche. Think of it as seed capital. Any questions so far? Okay. Now, these 2 steps are the same regardless. If we are going after an SBA loan or a non-SBA loan, this is where everyone starts, by the way. So steps 1 and 2 are not specific to ABL. This is just how our model starts. Okay, let's move on then. So now we need to get so we've got the application in for the first tranche. Client gets offers typically within 24 hours. And from that, then the client can choose which offers they want. They can select one offer. They can select multiple. All clients get at least one offer. The amount of offers they get is based upon their credibility. It could be 30, 40, 50,000. Once in a while, we'll have people get over 100 or 200,000. But the first tranche is based upon their baseline credibility. Everyone will get at least one offer. But the norm, and so that's why we're saying, don't use this as some sort of guarantee, because steps 1 and 2 should fall into line consistently. The amount of first tranche funding of first working capital will vary by client, but on average, we would expect them to get about 20,000. And so some people are very short-sighted and like, well, that's a scam. They're only getting 20,000. We told them 1 million. Well, this is just the first step, right? It's a process. So the first step would normally, the first round of funding would normally be about 20,000. So no, it doesn't cure all their financial woes, but it's enough to give them some working capital and allows everything else to be funded by the program. Because what I said is we've designed this ABL process, and I'll add that, to be less than 500 out of pocket to the client. So other than them getting, and the shelf corp's free, I know, but they pay the processing fee. And if you're marking it up, of course, that's going to change this number. But if you're not marking it up, this is all they should have out of pocket. Everything else should be self-supported through the campaign. And that's because we're getting them working capital, seed capital, about 10 days in. So not 10 days after step 2, about 10 days from the beginning. 7 days to get them the shelf corp, get the app, give them the offers, they accept the offers, and it could vary, right? Different lenders have different turnaround time, but for an ideal scenario, they would get multiple offers. They pick the ones they want. On average, it's around 20,000, and it would be in their pocket in around 10 days from the start. Vanessa asked if they don't get any offers. I'm telling you, no one gets zero offers. No one gets zero offers. The model is built where everyone gets at least one offer. Many people get multiple offers. Everyone gets at least one offer. But how much they get, how many offers they get is based upon their credibility. All right, so let's move on now. So where we're at now, first three steps are not specific to ABL. This is just how our model works, no matter if we're going after ABL or SBA loans or whatever, business acquisitions, real estate purchases, steps 1, 2, 3, that's just normal. Okay, let's move on. Now, if they do want to pursue ABL, which I think many of your clients will, if you educate them properly, and of course we'll educate them, I suspect that 9 out of 10 of your clients will choose ABL, asset-based lending, over any of the other options in the marketplace. But it's up to them. If they want SBA, non-SBA, ABL, whatever they want, we'll work with them on. So if we're going to do ABL, we need asset-based lending. We need to provide them assets, right? Because that's what it's predicated on. So we provide that. So that gets back to what Doug, and again, we've got 3 or 4 Dougs on here, but one of the Dougs, Doug 1 earlier said, well, what if they don't have the assets? Well, that's why we've designed this. If they already had the assets, frankly, they don't need us. They just need to go over and get with Seth. But if they don't have the assets, that's where you and I come in. So we can provide them $1 million. Now, it could be more than $1 million, but we normally start at $1 million because that's where most of the lenders are. Again, I know Bank of America says $5 million, but not all of them have a $5 million floor. So we'll send the $1 million of assets to the client. And so that's normally around 2 weeks into the process because we were at day 10 here. So add about 4 days. And then if the client wants, we can liquidate the AR. So let's dig into this. So there's really 2 different transactions here. The first transaction is if the client wants ABL, asset-based lending, and they don't have enough assets, then we can transfer that to them. So that's the first part of the sentence. And then we have the conjunction and then secondly, optionally, if they want us to, we can liquidate the AR. Why would you want to liquidate the AR? Well, we want to turn it into cash, and I'll show you here in a minute why that's really important from the client's perspective, cash flow wise. But also, most lenders that offer asset-based lending want to see that there is a collection effort in place. So this is the norm, that together. All right, move on to number 5. So while ABL, asset-based lending, is certainly a simpler approach to getting funding than normal loans or SBA, that doesn't mean that there's nothing needed. That's too good to be true. So it's more reliant on the AR reports. We'll take care of that. So if the client gets the assets from us and engages us in liquidating the AR, then we'll handle the AR reporting. I see Chris is asking, do we charge for that? No, sir. No, if they're doing number 4, we'll do number 5, and there's no cost because it's integral. With that, you could have the AR, but if you couldn't generate the right type of reports, they wouldn't get approved. So we're not going to leave them hanging. So if they get 4 from us, then we'll deliver 5. Now, once in a while, you'll have a client that says, oh, I already have enough assets. Well, if they already have enough assets, then they don't need number 4 from us. And then, of course, we're not going to do number 5 because we don't know enough about their assets. Any of the assets we provide, we know, we understand. Drake's bringing up a good point. So, and it's a little bit off, but I'll bring it up. So when we talk about these AR reports, what's very powerful, and Drake's a little more sophisticated than a lot of our distribution partners, what he realizes is the AR report's going to show 2 types of activities. So let's go ahead and mention that. So the AR reports, so the lenders will typically need AR reports, if not weekly, at least monthly. We'll take care of that. Why do they want to see that? They want to see that money is being collected. And they also want to see how the balances are increasing. And I'm getting back to Drake's point. Thank you for bringing it up. So you might say, well, sure, if we're liquidating the AR, collecting the money, then the amount of AR is going to go down. Isn't that a problem? Won't the lender hate that? Well, no, that's what's expected. They want to see that the AR is going down because that's turned into cash and the money in the bank account goes up. That's what's expected. But I think what stumbles some people is like, well, if we're collecting money, how are the balances going up? Well, the way that we manage, so we're licensed, bonded, and insured as a debt collector. You've heard that before. So everything we do is legal and compliant. But the way that we do it is we're adding daily late fees, $50 a day, to each account. So if the debtor doesn't pay, not only do they still owe, the amount they owe goes up and up and up. And you need that. You need consequences. Otherwise, what would motivate them to pay? Until we sue them and garnish their wages and take their assets. So the point is, if you look at $50 a day late fees, well, let's break it down a little bit more. So in a $1 million portfolio, it's going to normally have 100 accounts of 10,000 per. So in other words, there's 100 debtors that owe 10,000 apiece. Multiply those together, we get a 1 million. So that's the construct of it. So this is real, right? This isn't make believe. We're not going to do bank fraud. This is real. So there really are 100 debtors that owe 10,000 apiece. Tying it back to this point here, we'll put an asterisk. How does the balance go up? So there's a $50 a day per day late fee. So let's take just one account. So the one account, let's say we got a stubborn debtor. They haven't paid yet. They owe 10,000 on, we'll just say on September 1st. How much do they owe by October 1st, 2025? Well, they're going to owe the original 10,000 if they were stubborn, which isn't smart. But they're going to also owe $50 a day times around 30 days in the month, an extra $1,500. So now they owe $11,500. So that's what's marvelous. If you read Rich Dad, Poor Dad by Robert Kiyosaki, or look at any way of building wealth, one of the key strategies of building wealth is having assets that spit off cash and that grow in value. Well, either it spits off cash because they're paying, or the balances increase. And again, some of you are financially minded and some aren't, but you're looking at a $1,500 increase due to late fees per month. So over a course of a year, and we wouldn't expect to take a year, it's gone up $18,000. So if you're financially minded, you see how powerful that is. But let's get back on track. So we provided them the million of assets. They've engaged us in the liquidation. We're developing the reports. And then normally about a week after that, we can go ahead and apply for the asset-based loan. Then what happens? Client receives the $1 million. And I see Jeff's asking, what if they need more than $1 million? So we do it in million increments. So it's okay if they need more than $1 million, but it's just replicating the $1 million model. So they could do 2 or 3 or 4 or what have you. All right, so then let's move on here. Okay, so then what we wanted to do is to look at the monthly model here. So what's happening in the beginning is the client is getting the number 7. They're getting the $1 million. That's assuming they're doing the term loan. If they're doing the line of credit, then they can pull from that when they want. So that happens here in the beginning. But this is a loan. Well, let's assume it's not a line of credit. So this is a loan, right? So what does Bank of America or these other lenders want? They want the borrower, you're my client, to pay them back. So each month there's going to be a payment, right? That's the way loans work. Well, how are they going to cover that payment? That's the marvelous part of it. So we've already talked about we're liquidating the AR. So our goal is, and our plan, what we expect to happen is each month we collect enough off of the AR to cover the client's monthly note. Pretty powerful if you think about it. All right, moving on here. So what are the bottom line benefits to the client? Well, $1 million loan, and then up to, depending on how much of the $1 million of AR we collect, up to $1 million in cash deposits. So if you add those two together, this is cumulative, right? So let's change this to say 1 million in funding plus. So their potential cash receipts from this transaction is $2 million. And how much did they spend out of pocket to get started? Less than $500. All they had to do is pay the processing fee for the free shelf corp. Everything else was self-sustained through the working capital. What are the benefits to you? This is our last point. Well, to you, you're helping people. And I know a lot of you, you're more worried about helping people than you are making money, which is fine, but we can do both things. We can help people and make money. So we can help people get $1 million plus when you consider the two elements. And they're only out of pockets 500, right? If they can't afford $500, then they're just not ready for ABL. But that's a remarkably affordable out-of-pocket cost. And frankly, and I see Willie's making a point, yeah, technically they can reimburse themselves because when they get the seed capital around day 10, they could write a check to themselves or do a transfer and reimburse them for the initial out-of-pocket. So really, they only have $499 out-of-pocket for a period of 2 weeks, and then the capital raise is supporting itself. But from your perspective, which is where we're helping people, which is a good thing. And then secondly, if you're on the normal comp plan, you're making 5 points. 5 points of $1 million is 50,000. And again, you got like Barney Barker on here, an extra 50,000 a client. It's not going to impress a lot of you, but if you do a client or two a month, let's just set a goal to do 2 ABLs a month. That's 100,000 a month. That's 1.2 million a year, and it's taking next to none of your time. All right, so with that, we're going to go over to your questions, comments, concerns. My goal was to take you through a normal, a predicted, an example, step-by-step guide. Because I think a lot of you see the value in the ABL. Maybe you didn't realize it's as mainstream as it is, as we're showing on Bank of America's website. And then secondly, some of you just needed to better understand the steps. But again, the first 3 steps are the same regardless if we're going after ABL or SB. I'm sorry, first 3 steps is if we're going after ABL, SBA, or what have you. Once we get to this point, then we're working with the client to figure out how much money they want, uses of funds, match them to the right lender. But I anticipate the majority of your clients are going to really like the ABL. All right. T. Jacques asked about the performance fee, and that's right. Yeah. So in our model, the client's paying 10% of the capital raised. Half of that is going to you, and that's where that number came from. That's right. Okay, Lana's asking about the first round, the first tranche. And so that was here on number 2. Yeah, so we have a simplified 1-page application. The top half has information about the shelf corp, which frankly we can provide for them because we know all that information. And then the bottom half is the business owner. And with that app, without any hard inquiries, we can get them offers. Most people get multiple offers. A lot of times they'll get more than 10, more than 20 offers. They can choose multiple offers to kind of stack their working capital, but they normally can't accept more than 1 offer per lender. But the average client will get offers from like 6 different lenders. So theoretically, they could stack that up. Instead of it being 20, they could very well get 30, 40, 50, 60, 70 for the first tranche. Hopefully that helps, Lana. Good question. Again, Vanessa had asked earlier, what if they don't get any offers? I'd responded to that already. I just didn't clear the message. No, everyone gets at least one offer. The model is built to not leave anyone behind. Let's see here. Kenneth says, what happens if more than the amount you borrowed is collected? Okay, well, so I think what Kenneth's asking, so there's two separate activities going on. There's the loan for the ABL, and then secondly, there's the collection of the AR. They complement each other, as we talked about. So the goal is to get enough money collected from the AR to cover the loan payments, but they're technically two different transactions. Yeah. So Kenneth is asking. Let's say in month one we collect 25,000 of AR. We collected 25,000 from the debtors. We know on $1 million loan, the typical monthly payment is going to be about half that. So Kenneth is asking, what happens with the extra money? Well, it goes to the client. Yeah, so it's the client's extra money. No one's holding it or keeping it or taking it. Selena's asking, where is the $50 a day late fee coming from? So there are debt instruments, because when we're talking about AR, let's get down here to number 4. So AR means accounts receivables. We're transferring $1 million of accounts receivables over. And as I broke this down, that's normally 100 accounts that owe the creditor, their debtors, owe the creditor 10,000 apiece. So the late fees are charged to the debtors. But if that didn't make sense, maybe let me know. Let's see. Chris asked, doesn't the client have to pay a minimum of 1%? I don't think so. I see what he's saying. And I'm sorry, I'm putting the pieces together. Yeah, so if the client wants to use the ABL, the asset-based lending, sorry, Chris, it took me a moment to register that. So if they want to use the asset-based lending, then yes, they have to purchase the assets from us. That's correct. We sell it for 1 cent on a dollar. That's what he was saying. And that's correct, but that doesn't need to come out of the client's out of pocket. That'll come out of their first tranche. Vanessa says she's ready to make some money. Yeah, we can help a lot of people with this. It's just you have to educate. It goes back. A lot of people, they don't know about ABL. It sounds foreign to them, or they may not think it's as legitimate as it is, or they don't think they qualify. Well, they may not qualify, but you and I can help them qualify. All right, let's see here. Joseph's asking about the fees to liquidate, and that's a good point. So we're licensed, bonded, insured as a debt collection company, so debt collection agency. So we do charge to liquidate the AR, but those fees are paid by the debtor, not by the creditor. So in addition to the base amount, the 10,000 that the debtor owes, we add on to that the collection and legal fees. So yeah, there's a cost of collections, but it's just not paid by your client. Mark asked, would you need a second shelf corp for the ABL? No, not necessarily. No, you could have, we could use the shelf corp mark that you already have, because let's go back to the steps. Mark, we've already gone through steps 1 and 2 for you. So no, we don't have to go get a new shelf corp. If you already have a shelf corp, let's use it. There's no reason not to unless you don't want to. Let's see. A few other notes, but running along. So I think I'll leave it at that for today. So again, if you need individualized assistance, text us. But in closing, you and I are in an incredible place to be able to go out and help people. If nothing else, educate them. Let them know anyone can get $1 million. We just need to build the paperwork out legally and ethically to qualify. That's going to sound too good to a lot of people until you educate them. And so going out and educating, When we were first getting started, we were going to churches and apartment complexes and chambers of commerce, getting the rooms reserved, buying pizza, bringing in a case of water, and we'd educate anyone and everyone we could. You can create awareness however you want, but a lot of people aren't as smart as you. They don't know how this works. And so they're sitting there needing money, when in fact, there's banks and lenders that are looking to loan it. All right. Well, thanks, everyone. Have a great day. Let us know if there's anything we can do for you, and we'll see you back tomorrow morning. Have a good day. Bye.